What SPIVA tells us is that beating the market is difficult. What our persistence scorecards do, and it takes it one step further, is it tells us that identifying those winners, those winning managers, is really tough as well.
Welcome back to The Long-Term Investor. Today, I'm excited to be joined by Ganti, head of U.S. Index Investment Strategy for S&P Dow Jones Indices. Anu, thank you so much for joining me here today.
Thank you, Peter. It's so nice to be here.
We have talked about having this conversation for a while, and we could not have timed it better because today the SPIVA, or the S&P Index versus Active Scorecard, is out to the public. So let's start there. What did the SPIVA U.S. scorecard tell us?
We're very excited about SPIVA for a couple of reasons. One is we now have 25 years of annual history. So it's been so interesting to watch the evolution of this franchise over the past couple of decades. And first, just a little bit of background for you. SPIVA stands for S&P Indices versus Active, and we've been producing it for a long time now. It started in the U.S. and it's expanded to Europe as well as now Asia. So we do it all around the world, which is pretty fascinating. Now, getting into the basics of what SPIVA shows you is we measure active manager performance versus the appropriate benchmarks. And we started doing it with equities, and then we expanded it to fixed income. We also have international categories. The most important number that I would call out is the underperformance rate, particularly for our large cap equity funds versus the S&P 500. Having said that, there's a whole host of metrics to dive into, including, for example, asset weighted average performance, equal weighted average performance. We've got survivorship, where we account for the entire opportunity set, as well as quartile breakpoints. So there's a lot of statistics in here to digest. But coming back to the question, which is how did the numbers look last year? It was very interesting. We saw that 79% of large cap managers underperformed the S&P 500. So that's the headline number for you. It was also a very interesting year because, of course, if we think back to early April of last year and the tariff-related tumult, we were closely approaching bear market territory. And then we saw the significant rebound of the benchmark and the S&P 500 and technology. So in this kind of environment, and we're in a similar environment right now, where there's that greater volatility, market declines. This is typically when we hear that it's a stock picker's market. Right. And active managers have the potential to shine. So for us, it was a bit surprising to see the 79%. It was also, for context, it was the fourth worst year in our 25-year history. It was the worst underperformance since 2021. So relatively bleak results from that context, just given the tailwinds that we saw last year.
That's really interesting. And you mentioned, this is a data-heavy report, but one of the things that I think you and your team have done a really nice job of is making it so accessible. And so I'll be sure to link to this report in the show notes at thelongterminvestor.com. And the exhibits, the way that the data is structured, I don't think you have to be a financial expert to understand what you're looking at. And you mentioned, okay, the numbers that just came out, we know that 79% of large cap domestic equity funds underperform the S&P 500. And you mentioned in what people would have called a stock picker's market. And you and I have joked before, I feel like we always hear that it's a stock picker's market. But can you kind of walk us through the history of some of the data and how you've seen changes over time, as well as maybe how things have not changed?
Sure. It's an excellent question. And one of the points that I like to talk about is when we show the underperformance rate, we show it over a 1-year period all the way out to 20 years. And if you look at the 20-year numbers, they're very stable. And there's a lot of noise in the short term. Markets change, there's declines, there's gains. But over the long term, once you get out to the 10-year, 15-year, 20-year mark, that's where things get really tough. And we roughly see more than 90% of managers underperform the benchmark, which is an important point that really shows the challenges of beating the index and the benefits that indices offer. But I will say it was an unusual year for a couple of reasons. One is we had that higher dispersion or cross sectional volatility. So when you think about conditions for active, we tend to think, if it's a stock picker's market, if I had a crystal ball, what would I wish for? What kind of conditions would I want? And one of them would be that greater dispersion, that greater cross sectional volatility. Because if I have the skill as a stock picker and I make the right call, there's greater value add, greater bang for your buck. And we did see that last year. We did see that higher dispersion, but we especially saw it in May of last year, post the tariff related tumult, as the market was assessing what would be the winners of tariff related policies, what would be the losers of tariff related policies. So that was a really opportune time. The other element and measure that we look at is just the percentage of stocks that are beating the S&P 500, and that number was 62% in Q1. So pretty good circumstances. Then it subsequently went down. For the year, it was only 30% of stocks that beat the S&P 500. So still tougher times. Another potential tailwind, and I know, I'm sure you've seen this as well, is just the talk of big tech, the Mag 7, market concentration, which can be a headwind for more concentrated managers. And there's so many different ways to measure this. A simple way that we looked at is we just took the top 5 stocks in the S&P 500 and we looked at their contribution. And that contribution went roughly steadily down from Q1 to Q4, which may have been a potential tailwind for the managers that are underweight these big stocks. Now, having said that, there's another element, which is we looked at our equal weight index. And I like to look at that because that's a measure of just the average stock, right? How's the average stock doing? And we saw that equal weight actually outperformed in Q1, and then it subsequently underperformed. Although it did pick up a little bit in the latter part of the year as we saw smaller caps turn around, more domestically sensitive stocks do better. But what I like to say, it was sort of a too little, too late moment in this scenario. So you had this mixture, this amalgamation of some tailwinds, some headwinds, but overall it was a tougher year.
That's really fascinating. And as I think and looking even at the exhibits of the year to year underperformance of both US and international funds, it kind of gets me thinking back. Oh, I remember when this happened. Maybe that's why the number moved, or maybe that's why the number jumped or fell. But then I scroll down and I look at, and you referenced this already, like the 20-year data, or if you look at the 3-year data or the 5-year or 10-year data, and generally what you're going to see, and I'm generalizing here a bit. Well, here, why don't I read some numbers? So I see of all domestic funds, the 3-year percentage of managers underperforming is 80.4%. The 5-year is 91.47%. The 10-year, the 15-year, the 20-year, they're all over 90%. So I guess, Anu, let me ask you this. Why do so many managers fail to beat the index over the long term?
That is the big question. Right, Peter. When we look at the SPIVA scorecard, and I'll give you a few reasons to set the stage, because we have identified that this is tough, right? Beating the benchmark is tough business. So a few key reasons. Number one, I think, is cost, right? Because we show the net of fees underperformance rates, and index funds have generally had an advantage over the cost front. And at S&P, we actually estimate the cost, the fee savings that index investors have achieved. It was roughly 52 billion last year. And what we do is we take the indexed assets associated with the S&P 500, the S&P 400, and the S&P 600. So you've got large, mid, and small caps. And we multiply that by the fee differential between active versus passive funds. So you get to that number, but I will say it actually understates the full amount of cost savings because we're only looking at a few of our indices. We're not looking at everything. We're not looking at the entire industry. So that is a really powerful benefit of index-based investing. The other element, and I think this is a really underappreciated element, is just the skewness of equity returns. And I think if you think back to, I don't know, high school statistics class or math class, right? And remember the bell curve, the normal distribution. Stocks don't work like that. Unfortunately, a stock can go down to zero, but it can appreciate by much more than that. As a result, what we tend to see, and there's been a lot of research on this side, is that equity markets tend to be positively skewed. And we talk about this, and then the next question is, so what? The important rationale from that perspective is that outperformance tends to come from a few stocks, a few winners. So if you're a more concentrated manager holding fewer stocks, you might be less likely to hold one of those precious few winners. So it really makes the case for diversification, just having more stocks, a chance of owning those likely winners. So that's an important point. And in fact, we've looked at the skewness in US equity markets. We look at it all around the world. It's pretty fascinating that for most of these years, most of these equity markets have been positively skewed. The final point that I'll say on this front is just the professionalization of the industry. So I think if you and I were talking, say, in the early 1970s, things would have been very different. And we saw the market become more professionalized, more institutionalized, which has just made things more competitive. If you think about it, because as you have these assets going to passive, it's sort of a weeding out process, right? And then you have the average ability of the survivors going up. And people are smarter. We have access to more technologies, so the game has just gotten harder. And one of my favorite words to use, I don't think it's officially in the dictionary yet, but I think we'll get it there. It's called indicize. And basically it means to put it into passive form strategies that say 50 years ago you would have had to go for in an active format, but now you have the passive option available. So those are a few of the reasons.
I think to me, that is one of the most, those reasons make perfect sense to me. They're probably the most important part of this study to me personally, in terms of trying to coach investors to minimize mistakes. I think a lot of investing success is about minimizing mistakes and just staying the heck out of the way of compound interest way. Like let compound interest do its thing. And you mentioned cost. That seems like such a pervasive one. You mentioned the competition. I mean, when you are thinking about who is out there in the market setting prices and the amount of PhDs and Bloomberg terminals and incentives to go try to find an undervalued security or an overvalued security. It just, if there's something that's obvious out there, it just gets competed away so quickly. But there's one thing that you said that started getting me onto Google so I could find the stat real quickly. You mentioned, you have to, a small percentage of stocks drive all the returns. And there's a paper by Hendrik Bessenbender, do stocks outperform treasury bills is what it's called. And so he looked at US common stocks from 1926 through 2016. Not only did he find the median stock generated a return of negative 3.66%, but he found that only 90 companies, just 90 out of the 25,967 companies, generated half of the return. So it's 0.33%. So I think if you're an individual investor out there, you're trying to do this yourself. I mean, look, to me, the data says that if the pros can't do it, why could you? Another thing is if you think the pros can do it, you just have to wonder, like, how could so many people possibly be adding value at this stage? Now, I guess, let me ask a question that maybe I know what your answer will be, but there are people who do beat the benchmark. I sometimes hear people say, well, then why not just invest in those managers who beat the benchmark? What would you say to that?
Yes, and I love this question. It's a very common one that we get, and we're certainly not saying that there's no outperformers. They're out there, right? They're certainly outperformers. But what Spiva tells us is that beating the market is difficult, right? And I think what our persistence scorecards do, and it takes it one step further, is it tells us that identifying those winners, those winning managers, is really tough as well. Because, for example, if you have an outperforming manager, say this year or last year, chances are next year or in 5 years or 10 years, is the outperformer going to be that same manager? Our persistence scorecard actually shows that it could change. That what happens is you have these top performers, but that the outperformance tends to be fleeting, right? And I think that's a really important point. And what that actually tells us is that active outperformance, when it occurs, it tends to be more the result of luck rather than skill. Because, if I'm a manager and I have the skill and I outperformed last year, chances are I'm going to outperform next year and the year after that and the year after that. So, going back to that point about picking the outperformers, they're out there. It's just they're really hard to find. And manager selection is so tough as well.
Well, and you need a lot of data points to assess whether outperformance was the result of skill or luck. And what I'm going to say can be debated and disputed, but if you were like only using annual data points, you would need almost 40 years worth of data to assess whether the outperformance was due to skill or luck. Now, if you use monthly data, I realize the number's different and there's maybe some things you could do at the margins, but you mentioned the persistence scorecard. I believe there's an update to that coming out in a few months, but if I just look at the year end one from 20 that goes through 2024, I can see that only 2% of all large cap equity funds remained in the top half over a 5-year period, meaning if they're in the top half, only just a few of them survived in the top half the next 5 years. And so it goes to show you. And the thing that's great about the persistence scorecard, and I'll link to that too in the show notes at thelongterminvestor.com, is you'll look at, hey, how did people in the top quartile do over the last 3 years? And then how did they do over the next 3 years? And then you also do that for the 5-year periods. I know that those numbers are coming out sometime in the next few months, but can you maybe, I kind of spoiled one of the results, but do you have off the top of your head a memory of what some of those results showed in the prior year's report?
Yes, and you alluded to some of those important findings from the persistence scorecard, and we do this once a year. Like I said, it's sort of the sister scorecard to SPIVA and takes it a step further in terms of looking at persistence relative to peers within a fund category, as well as persistence of alpha. How consistently are you beating the benchmark? And the report's findings show exactly what you said. And you mentioned the 2% stat for large cap funds, only 2% staying in the top half over a 5-year period. And to put it into perspective, if you think about flipping a coin, right? And just flipping a coin and having that random distribution over a 5-year period, it was actually less than the chances that you would have flipping a coin, which I think really puts it into context onto how difficult manager selection is. A couple of other points for you on persistence is we slice and dice it a lot of different ways. So we look at funds in the top quartile, in the top half. We look over a 3-year period. We look over a 5-year period. We have transition matrices showing the evolution over the quartiles and the halves. We also show the persistence in the rankings over consecutive 3 and 5-year periods. And no matter how you slice and dice it, the end result is very consistent, as we've talked about from year to year. And another finding for you, if you just look at funds within the top quartile, none of them were able to stay in the top quartile over a 5-year period. So really powerful findings here. I will add one more point is we actually see persistence on the other end of the spectrum. And what I mean is if you look at the bottom performing quartiles, for example, we see increased likelihood of them getting merged or liquidated in the subsequent 3 years, in the subsequent 5 years, which intuitively makes sense, right? Because if you're consistently an underperformer, it's going to be harder to perform and stay in business.
You've already referenced this that, if we're going to take the SPIVA and the persistence scorecard and put them together, a big takeaway is that, hey, it's really hard to beat the market. I mean, what other actionable insights when you publish this are you hoping that people glean?
Excellent question. And I think there's a few things here. And we like to think of the SPIVA scorecard and persistence as tools for education, as tools for the market, and for investors. Because, for example, if you look at the SPIVA U.S. scorecard, there's 38 categories in there. And we've talked a lot about large caps, but you can look at large caps versus mid and small caps. Mid and small caps did relatively better. You can look at value versus growth. We can look at international funds. We can look at all the fixed income categories and look at survivorship, for example. So we like to think of it as a tool for the market to understand which categories are doing better, which categories are doing worse, for example. And we offer that transparency with SPIVA. Because, for example, in years that were relatively better, for example, we call out the numbers and we continue to keep reporting the numbers, which has been so great to see over the past couple of decades.
I'm going to kind of take a turn to some maybe trickier, more abstract topics here. There is something, I have a book coming out in September. It's called The Perfect Portfolio. And this is my second book. And both in the first book and this book, I reference the SPIVA results. I reference the Persistence Scorecard. I think they make a really important point. When I started my career in 2007, it was a big debate. Like active versus passive was a debate that didn't seem settled. And S&P offered a scorecard of sorts, a scoreboard. I mean, I guess you do call it a scorecard. One of the things, though, that I think has been interesting since then is kind of thinking, is active versus passive the right debate? And so let me kind of share some thoughts and then you can react. Because to me, it's a lot more about like, hey, was it low cost or high cost? Was it something that required predicting the future versus was it rules based? And so, for example, you can have a factor fund that is not passive in the sense that it's not an index, but it also isn't active in the sense that it's a traditional stock picking fund. So how do you think about that? I don't know exactly what the question is, if I'm being honest, is I think that active versus passive is the wrong conversation. What are your thoughts on that?
Yes, you're certainly seeing that blurring of the lines. If you sort of think of a imaginary Venn diagram, for example, with active on the one side and passive on the other, and what you asked and what you alluded to sort of reminds me of another piece of research that we produced. It's called the liquidity landscape, and what we do is we track all the trading volumes tied to all the products tied to our indices. And there are some really fascinating findings in there. And one of them is that we're increasingly seeing greater trading, greater active usage of passive index based products. And it's sort of a initial misnomer if you think about, indexing. A lot of people can think, it's set it and forget it. I buy and hold. In fact, it's quite the opposite that we've seen. And we've just seen a variety of holding periods. If you think about sectors, for example, increased usage of sector based index products. So now, if you think about it, these aren't just indexers, for example. So, again, going back to that Venn diagram, it could be long term buy and hold indexers, it could be more tactical users going in and out of sectors, it could be somewhere in between. And that's really the beauty of this is to sort of, we call this the harmonics, right? And I published a blog. It was called a creative cacophony. Got all these different noises: short term, tactical, long term, buy and hold, somewhere in between. But it's really this continuum, if you think about it, between active versus passive. And I think that really goes back to the benefits of having these indices and having these index based products to just offer more choices.
Well, and to me, benchmarks and indices, if I go back to that group at University of Chicago who created a lot of the first indices, or at least that's my understanding of the history. I could be wrong there, but they were doing so not to even create a product. They were doing so to better understand performance. They were doing to measure performance of other investors, to better understand asset pricing, and that it was ultimately developed into product was never really the intention of why it's born. And so I like the point that you make, one, that there's a continuum, and two, that here we are, it can be used a lot of different ways. And part of the reason I've kind of said, hey, active versus passive doesn't always seem like the right conversation. And I do like that you're talking about it as a continuum, is because if you own indexes, you can be very active with them. The other thing is there are all these rules-based funds, and indexes are just a rules-based fund. They typically follow one rule for a universe. Actually, and out of curiosity, I mean, for something like a factor fund, do those show up in the SPIVA reports, or is that just traditional active management? Like, what are the types of funds you'll find in that report?
Yeah, no, it's a great point, and if you go to our appendix within SPIVA, you can read more about all the different categories and different types of funds that are covered. What we actually use is we use the CRISP survivorship-free mutual fund database, and we use all the U.S. domiciled funds, and we categorize using a Lipper-based classification. And some examples for you that I talked about earlier is large caps, mid caps, small caps within equities, core, value, growth. For example, we also have international funds, we have global funds, we have emerging market funds. Now, when we come to fixed income, really runs the gamut from government debt based funds to investment grade to high yield to leveraged loans. So increasingly, as we've evolved SPIVA over the past couple of decades, we've expanded the fund categories, and it's been very exciting to now have fixed income categories and fixed income underperformance rates out to 20 years because that's a related point, related conversation, and we could do a whole separate conversation on this, Peter. It's just the evolution of bond indexing and fixed income indexing. And so it's nice to have all of these different categories to compare against.
That's actually one of my hot button topics, but I will hold so that we don't run a 2 hour long podcast here. Let me ask you though, on more kind of continuing down that path that I'll just say is like indexing does not equal passive. Maybe that's what I'll call the path that we're on. When an investor is choosing an investment product that has an underlying index as what it's going to track, you know, as a brand name index, what would you say that investors ought to be considering as they look at a fund sponsor who has three large cap funds, all different major index providers? What are some of the things that you think that they ought to be thinking about as they make a choice there?
Yes, and especially now, there's so much information available at our fingertips. So a couple of things on that point. If you look at the S&P 500, for example, and related indices, and we've talked about sectors and small caps earlier. One is index methodology is super important to understand. So if you pick one of our indices, for example, and you go on our website, you can read all about the methodology and what makes the index tick. For example, so if I wanted to build a value index, the new value index, and you were making the Peter value index, we could make very different indices. But if you look at the S&P value index, S&P 500 value index, it has specific criteria. For example, so a couple of things to point out is what are the metrics that are being measured for said index. The other thing is how frequently is the index being rebalanced? For example, is it a quarterly basis? Is it a semi-annual? Is it an annual basis? What is the process for constituent inclusion and exclusion? Is there liquidity criteria? So all of this is available on our website with our methodologies and our fact sheet, and we've tried to make those resources available to everyone's fingertips to increase that education of how is an index built, what are the associate products tied to the indices, the liquidity. I talked about the liquidity landscape earlier, and the trading volumes associated with our ecosystem. And that's another powerful word is it's just the word ecosystem. And we talk a lot about the S&P 500 ecosystem and its growth, which really serves to offer price discovery. As an example, again, going back to our conversation in the 1970s example earlier, then index-based derivatives, a lot of them weren't available at the time. Now they are. So increasingly, there's just so much more exposure nowadays and so much more information. But going back to your initial point and initial question, transparency index methodology is super important to understand. Also, for example, understanding the geographical tilts within an index and in a global index. For example, how is a country classified, sector weights, and because these things can change. And another example for you is if you take a sector index, for example, in one of our market commentaries, we regularly look at the factor exposures. for example, of said index, of said sector index, and they're not static, right? Which is why we track them every month. They continue to move around. So those are a few things.
That's fascinating to me. I didn't realize how different indexes were until like the late noughts. So sometime in the financial crisis where I was tasked with rebuilding some capital market assumptions and not knowing which small cap index to use or which large cap index to use. I just used them all and I averaged them, and not saying that was the right approach, but I shortly thereafter, I've tried not to mention other index providers here, and I will be able to continue with this story and do so. But I
Appreciate that.
remember, I remember writing a piece on an ETF that tracked the S&P 600 index. And the thing that really caught my eye when I was looking at a recent performance trend was the simple rule at the time, I don't know if this still holds, that S&P required 4 quarters of profitability to be eligible for inclusion. And when you look at broader data sets on how small, unprofitable companies historically have, you know, trailed profitable companies or larger profitable companies, that, you know, it just was a very interesting thing. And it really occurs to me that there is a lot of nuance between these different indices. Now, I am going to close with what I would consider my hot button topic. And since you and I have never personally talked about this before, I'm very curious to hear what you think. I am going to touch on the fixed income side. Let's go broad first, though. Why don't we talk about what we know about active versus index performance on the fixed income side of things?
Sure, and there's so much to dive into within fixed income, like we talked about. Going back to last year and going back to the 2025 results, if you think about the fixed income conditions, it was moderately encouraging. There were a couple of tailwinds. Now, stepping back, when we think about the conditions for fixed income active managers, it's sort of a different lens, a different animal. If you think about it. And I like to break it down into 3 buckets. One of them is just thinking about term risk or duration. The other is credit, taking on credit tilts. And the other is illiquid exposure. So can you tilt towards more illiquid bonds? So you sort of have these 3 different levers, if you think about it, that bond managers can pull. Are they pulling on the credit lever? Are they taking on more duration? Are they taking on more illiquid risk? So what we did is we looked at this from an index lens, which was really fascinating to just dive in and look at the index conditions. And what we saw is that taking on more illiquid exposure wouldn't have helped you last year, so we didn't have that. If you think about credit exposure, there was some possibility, some greater potentially accretion to taking on credit, more credit exposures, but it wasn't as good as the year before. So in terms of putting it into perspective. And then final point, when you think about duration or interest rate risk, very unusual conditions compared to the year before, because if you remember, we had the inverted yield curve, right? And then we saw the disinversion, the normalization, steepening of the yield curve. So we found that going longer duration might have helped you. And then you got a bit of the credit exposure, but moderate tailwinds and not much from illiquid. You put that all together, and we got relatively tougher circumstances, and we saw higher underperformance for our high yield categories, for our general investment grade categories, for government. So generally challenging conditions within the fixed income space. I will say this is another space where there's a lot of noise in the short term. So, for example, if you look at the years earlier, there's certainly pockets of opportunity. And I will say that one bright spot was emerging market debt. We saw majority outperformance within EM debt. And I think a big tailwind there was just the weakening dollar, because as the dollar weakens, it can make it easier for issuers to pay back dollar denominated debt. So there were certainly bright spots to be found within active fixed income.
And one last question for you to close out. I don't know if there's a growing actual interest from investors or there's just a growing interest from people selling it, but there is a growing interest in private market exposure. That is notoriously difficult to get a lot of tracking information on just because not everybody has to report. There's some survivorship bias there, but is there anything that S&P has sought to do, given that there is just such an explosion in retail availability for private markets more recently?
Yes, it's such a hot topic right now that we're watching so closely. And I will say that from an index standpoint, we certainly have indices that cover this. One example is our S&P BDC index, tracks publicly traded BDCs. There's roughly 44 constituents within it. And it's certainly a timely, environment, especially as we speak right now, to be looking at these things, and especially to be looking at an index. Again, going back to the point I made earlier about diversification, because there's so much volatility right now. There's greater idiosyncratic risk popping up. In different sectors, going back to, we talked about information technology earlier, and we saw there's such a divergence between, for example, software companies versus chip makers. And if you think about software companies, there's a link there, right, to private credit and BDC exposure. So thinking about indices and thinking about diversification and an index-based approach is super timely.
Well, Anu, this has been such a thrill for me. Again, we've had the opportunity to speak in person. This is long overdue that we got on the podcast. What great timing with the release of so much information. I will be sure to link to all of that at thelongterminvestor.com. But if people want to find your work, you do a lot of writing yourself. Where's the best place to find you?
Yes, there's a lot of different places. One site that I'll recommend is our indexologyblog.com, where you'll see myself, members of my team frequently blog on timely topics. For example, SPIVA, fixed income equities, indices all around the world. We also offer shorter market commentaries and dashboards, and you can check those out on our website. And of course, coming back to the topic of the day, you can find SPIVA U.S. as well as all the different regional SPIVAs all on our website.
Anu Ganti, thank you so much for joining me here on The Long Term Investor. And for those of you watching us on Cheddar, be sure to subscribe to the podcast, either on YouTube or on your favorite podcast app. You will hear an extended portion of this conversation that you didn't necessarily get to see on TV today. Again, Anu, thank you for joining me here, and I hope to see you again soon.
Thank you so much, Peter. It was a pleasure.